Abdulasi in Dubai. She's a senior market analyst at Equiti Group. Hi there, Nadia. Now, the US inflation rate rose for a third time, but core CPI slowed down in December. What's helped bring down that core rate?
Hi, Taiba. Yes, I guess the core inflation did give some relief to investors despite the initial CPI actually going higher in the month of December. I guess what brought it down was food and volatile items going lower in the month of December. However, markets are trying to take that as a good sign because they're only trying to reflect the inflation numbers to what the Fed decision is going to be like in the next month. Now we're anticipating a pause. We thought that there was going to be a hike on the table, so I guess that took away from this expectation, because a hike on the table was going to change a lot of things in the market, was going to change market sentiment, was going to change a lot for earnings. Earnings have been doing so well in the markets due to the Fed doing the cuts. So I think while hikes were on the table, things were about to change. So now that inflation, the core inflation came at 0.2 less than the expectations, it provided some relief to the markets, and now we are expecting a pause for the next month. And I think that the more that we see things tied up to economic indicators, this will be reflected in market sentiment. For example, yesterday there was a lot of stock optimism. I guess stocks really took that well, and they were in the green yesterday. And also gold prices were elevated. They had their best performance in over a month. The dollar went down to its 2-month lows. So I think a lot of things have been changing, tied up to inflation data, which is headlines for 2025.
Okay, Nadia, we will come back to you in just a moment, but first let's take a quick look at some US bank earnings. Now, following the US Federal Reserve's much anticipated interest rate cuts last summer, the nation's banking sector is thriving despite challenging conditions. 4 of America's 6 largest lenders reported impressive fourth quarter profits, fueled in part by Donald Trump's election victory, which triggered a surge in trading activity on Wall Street. JP Morgan and Wells Fargo posted around a 50% jump in fourth quarter net income to $14 billion and $5.1 billion respectively. Goldman Sachs's doubled to $4.1 billion, and Citi also made a significant turnaround, swinging to a profit of $2.9 billion from a $1.8 billion loss in the final quarter of 2023. This strong performance was mainly driven by a spike in trading activity, particularly in equities, both before and after the US elections. Investment banking units also enjoyed a boost as companies took advantage of relatively low borrowing costs to raise debt. 2024 was a stellar year for US bank stocks, with shares surging after the presidential election. Optimism around inflation prompted investors to shift away from technology stocks to sectors poised to benefit from lower borrowing costs. Goldman Sachs, JP Morgan and Citi stood out as the top performers, significantly outpacing the S&P 500's 20% gain for the year. Let's go back to Nadia now. Nadia, now, firstly, with interest rates trending lower and trading activity booming, is this a sustainable model for banks' growth in the long term?
Yes, of course. The more rate cuts that we have, the more that we're going to see earnings being boosted, the more that businesses are going to be able to grow, the more that small businesses also, they'll be able to afford to get loans from the banks to be able to also afford growth. So, and we're also going to see that reflected in GDP numbers. We're anticipating better GDP numbers for this quarter in the US as well. And I think that the progress that has been made in terms of the trading volumes that we've seen post-elections. And I think that the Trump administration in general comes with a lot of optimism for equities, because the Trump administration does support a lot of, they decrease the corporate taxes, which has a lot to do with benefiting corporations. So I think that in total does work best for corporations, which then also reflects on earnings. So I think in general, this is the path. And also NVIDIA CEO, he did say that the export chips, they're going to do better under a Trump administration. So there's in general a lot of optimism and positive talk around the Trump administration, and he's going to take office in January 20th. So I think that's going also to boost a little bit of market sentiment. There is a little bit of uncertainty. It may boost safe haven demand a little bit because safe haven demand has been dented because of geopolitical tensions being overshadowed or easing up compared with last year, how the tensions were, they kept on rising. So now that we have a little bit of shift on the table, I think that the sentiment is a little bit uncertain. However, there is still optimism, especially that earnings are doing well, companies are doing well, and rate cuts are still on the table. Despite the pause that we're going to see in the next Fed meeting, we're still going to see at least 2 cuts. I think this is what they said in the last Fed meeting. They said that they're going down from 3 cuts to 2 cuts, but still this is going to boost the equity market.
Okay, Nadia El-Bilasi, Senior Market Analyst at Equiti Group. We'll have to leave it there. Thank you very much.